Hey guys, what's going on? It's your girl, author, motivational speaker, realtor, Ayeisha McNeil. A whole lot, right? Teacher. Hey, I continue to teach. I missed you guys. I know it's been a minute, and I always come back with, I know it's been a minute. Don't hold that against me. I wanted to come back when I had let this whole situation settle about the market, right? So today I'm going to talk to you a little bit about what's going on in the market. How do you understand it as a person who is looking to buy a home, right? That from that perspective. So let me let you guys know. You guys already know that the rates are being generated by the feds to go up, to go down, to go up, to go down. And everybody's making their own opinion as to what's going to happen in 2023 and 2024. We can predict some things, but you can't really predict everything to the T because you don't know how people, you know what I'm saying? People can really surprise you. People that had no money that come into money, or people that, came into money probably ain't got no more money, and whatever it might be, people surprise you on what their capability is. Yeah, you guys see this Miss Shirt, y'all know that. I may lose you, but I don't lose my value. I am. That's right. I am. Step into the AM-I Ayeisha McNeil. But back on subject. Listen, I missed you guys, but today I'm going to talk to you about the market. So you're going to be like, the market, what's going on? You guys know that I'm all about being a credit specialist, right? As well as a realtor. My background, I come from credit specialist and working in the bank, right? As a personal banker, doing managerial things, moving on up in positions and things like that, or getting ready to, or even having relationship with my mortgage broker within the bank, right? I would position people when it came to what documents that they needed. Well, what do those documents look like? Those documents look like your bank stuff, right? You might need 2 to 4 bank stuff, pay stubs rather. So 2 to 4 pay stubs from your current job. You want to typically be in the same industry for the last 2 years. Now, when you do a job change, you can do an explanation, but within the same industry, that's good. You also need 2 years of W 2s. Now, a lot of what's going on here, a lot of people that's in business for themselves, they think like, yo, I'm ready to come in and buy a house. If you got 3 years of W 2s and you're working in your own business, that's awesome. If you have 2 years of W 2s working in your own business, that's awesome too. But let me tell you why it's not really awesome on the flip side. On the flip side of owning your own business, a lot of y'all listen to y'all CPAs and they be telling you, listen, I could save you a lot of money. I can do this, I could do that. And before you know it, you wrote off everything. And your income shows you made 10,000 or $5,000 out of the business when you produced or generated $100,000. Now, I don't, I told people when I worked in the bank, I said, listen, are you paying yourself? You have to, as a business owner, consistently pay yourself. If you pay yourself monthly, then it better be worth the money that you're going to need when you're trying to qualify for a mortgage or even for a business loan. Let me tell y'all the things that can happen once you actually go up under the microscope. And I'm going to call the microscope the lender. Once you go under the lender, aka microscope, they start to look at everything. They fine tooth comb everything. So if you think that not being honest with your realtor or your lender is going to shoot you right through that microscope, it's not going to happen. So let's just say something that wasn't on your credit, right? So I discovered there's this thing, right, called Cavers. So if they don't see it on your credit and they're not allowed to go on your credit, they got this thing called Cavers. But then they have this other thing called CoreLogic, right? And I can break down and get into that because core logic is all about the credit, right? It's all about that. CAVR is about everything that might be on your credit, whether it's judgments and things like that, but cannot go onto your credit. So when you're looking at your credit face value, even you have to remember the things that you went through. Let's just say you did a timeshare. You might want to disclose that if you had an issue with the timeshare to your lender. And if the lender chooses to bypass that, it has to be over 2 years. 3 years, better, but over 2 years. And lenders still have their layer of protection and risk that they choose that they want to go through. Okay. Now, I told y'all before when I was doing credit specialist, I said never apply for a loan when you are at your max DTI. I don't know if y'all remember this, but this was when I was talking about credit a long time ago, right? I'm still doing credit education. So if you want to sign up, that's AyeishaMcNeil.com and sign up and let's work on that credit issue, okay? And this is why I tell people, do not apply for your, at the very max of your DTI, debt to income ratio. What does that mean? They take all the debts that you have, the debts, DEBTS, right? They take all your debts, and it doesn't matter if you owe 10,000 here, 5,000 here, 3,000 here. So if your minimum payments on that $5,000 is $32, then they're only adding the $32 up into your debt to income ratio. So let's just say you owe 40,000, but you pay out only 500 a month. For that 40,000, you only pay 500 a month, right? So that's your DTI because it's your debt to your income, right? They add those debts and then they go and say, okay, we're going to look at your income and see what is the percentage of your debt to your income. That means is your debts 20% of your income? Is your debt only 30% of your income? And that's fine. That's great. 20, 30% is great. Why? Because you're not at the max. And let me tell y'all what happened, what's going on with the market now. So those of you who applied for a loan for a mortgage, and you were at your maximum debt ratio, you got disqualified. So let's just say you was approved for $400,000, right? Guess what happened? Because you was at the max of your debt, you no longer qualify. Let me tell you why. Because you was at the maximum debt, which is probably about 45 to 50%, depending on what loan that you applied for, right? There's a certain debt to ratio that you can be at. One loan might have you at 40%. Another loan might have you at 45%. And if you at 50, that means the underwriter decided, okay, let me look at something more deeper and see if we can actually work this out. I mean, I wouldn't say go with the 50, but even being at 45 max with your DTI is really not a good thing because let me tell you why. Because when the feds introduced the Fed rates and they kept going up, so you got to apply that 5% and now it's 7%. Guess what happened? That 7% on that loan that you have to pay monthly, which is your principal and your interest payment, let alone your home insurance is not in there or anything else. So your principal and interest payment alone went up. So if you was at $1,500 at a 5%, and now you're at a $2,000 monthly payment, right? At 7%. Well, guess what? You was already at your max DTI, debt to income ratio. You cannot be past a certain debt to income ratio when qualifying for a mortgage. Because if you was at your max, they let you in there, right? Because you was at your max. But now, because the Fed raised the rates, now your payment is even higher and it puts you out of the ball game. You can no longer qualify for the loan, at least on that amount. So you was to qualify for what, 400,000. So now, let's say if you want to qualify for a loan, now they, based on your payment capability, because of your debt income to ratio, right? Guess what happened? you're not going to qualify for the 400,000. So now you need a lesser amount of home. So your payment could be around where you can afford it. So guess what happened? The same, so you go down instead of 400,000 to $275,000. Guess what? Your payment was the same when you got qualified for 400,000, but now you only qualify for 275, and now your payment is still 2,000 and change, right? Raise it now. If you had 275 when you got qualified, your payment probably would have been about 1,700. So what did that do to you? It took you out of the ball game of the $400,000 house, and it put you in a ball game of 275. That's if you still wanted to move forward and you went down because one, your credit was still good, right? And then your debt to income ratio went down with the lower payment, right? It kept it in the same bracket of the payment that you could afford. Now, for those of you who even at just the max of your DTI probably could not qualify for the loan. So when you dropped, let's say you was at 275, and I'm not talking about the 400,000 400K person that got qualified. I'm talking about if you qualified initially for 275 and that was your max, guess what? You can't qualify for 275, so you probably could qualify for $100,000 loan. So what did that do to people? Because no homes were out there that was worth anything, even at $250,000. So remember, the sellers was selling the house at market value and plus getting more money than it was worth because the buyer really, really wanted it. So guess what happened? For those of you who were actually initially qualified for 275, no longer qualified for 275. The same situation like the 400K who qualified for 400K and couldn't qualify for that at, when the rates went up from the feds, 1 week to the next week, a couple of days later and more, that person was qualified at 5% interest rate. So they qualified because they could afford the payment. Well, guess what? Now you got to get qualified for less money, but the same amount of payment, right? So now you got the same amount of payment that you would have had at $400,000. And you're like, wait a minute, this is ridiculous. When I was at 400,000, I qualified and my payment was 2,000. Now I'm at 275 and I'm still paying 2,000 monthly mortgage. Well, that's what happened with the feds. When the rates go up, it increased the payment amount, which also increased your DTI out of the ballpark because you was at max. So once again, those who initially qualified for 275 no longer qualify for 275. And guess what? They can't find a house that they're looking for 275, which they was initially qualified for, right? So they would have to take something where they really, really had to fix up. So now it's worse because the 275 qualification, now you could probably qualify for $150,000 because your payment is going to be the same at 275, just as much as it was at 150. Now that you qualify because of the rates, right? It's all about your debt to income ratio taking you out of the ballpark, but even your payment. But now let's look on the flip side. If you talk about, I don't want to buy a house, the rates are too much, it's too much, I don't want to pay no 2,000, guess what? Monthly rent right now for a 1-bedroom out there. I came from Jersey. Monthly rent for it was a studio out there in Jersey that was at $1,700. To renew the rent because of the market rate was going to take it up $500 a month. $500 a month. Then there was another apartment. Someone was renting an apartment for about maybe $2,300. In order to stay there, their rent would have went up to $3,000 for a 1-bedroom. So now I ask you this. I understand the rates are 7%, little below, above. You just don't know these days, right? You can't even say below and above. But the point is this. Do I want a $2,000 payment for my mortgage, which is my house? Or do I rather pay $3,000 where next year I'm going to have to think of where I'm going to move again and then pay the market rent there, right? Remember, these market rates are based on what's going on with these mortgages too. So if the mortgage is raising up their rates, the lenders are raising their rates up, right? So because they're raising their rates up and your payment's going to be higher with their rates, guess what happens? Those who can't buy a home, the apartments come in and swoop in and say, hey, this is our time now to raise the rents to market value and to get the people who can't afford that house they got qualified for a month or two ago. Let's get them in our apartment and make them pay $3,000 or $3,500. So when you look at it like that, you ask yourself, do I rather pay $2,000 on a mortgage or do I rather pay $3,000? And then in the next year, your rent goes up again. Mind you, some of these apartments are not giving you 12-month leases anymore. That means you are obligated for 13 months or better. At least the minimum is probably 13, 15, 18 months, 24 months in order to lock you in at that current rent. But this is the thing, just because your rent go up don't mean they're giving you anything extra. So let's just say you don't have a washing machine and a dryer. They're not giving you a washer and a dryer because they went up for the rent and rate or whatever. The rent, right? Because I remember living in an apartment. In order to have a washer and dryer, I had to pay an additional about $150 a month for a washer and dryer. So with no washer, I had a dryer of my own, right? So I am just saying to you guys, don't be bothered talking about, I don't want to buy a house because of the rates. Let me tell you something. It's all about your payment per month. If you can afford $3,000 in an apartment, why can't you afford to pay $2,000 for your mortgage? It's just my question. And a lot of you guys think, I don't want the responsibility. But let me tell you, there are freedoms in owning your own house. When you live in an apartment, you have to paint that apartment when you leave back to the same color if you decided you wanted to be creative in your apartment. If you wanted new carpet, they would clean your carpet, but they won't give you a new carpet in the apartment. But you can buy a new carpet in your own home. I'm not saying that it's all about a paint job or carpet. That's not what I'm saying. What I am saying is that, do you live in an apartment that give you nothing when they raise your rent $500 more a month? Okay. If 500 times 5, just 5 months, 500, let's say 500 times 6, right? What is 500 times 6? $3,000, right? So 3,000 and 3,000 is 6,000, right? So $6,000 more you pay for an apartment to stay. And this is just for a year, right? $6,000 more because they upped your rent $500 per month. And so what happened? That $6,000 you willing to pay, rather than come up with a certain amount of money for down payment and closing costs for your own house. Because when you get your first mortgage, your mortgage payment is going to be due like at least 45 days out, right? So yes, you have to pay that up front. But guess what? You lose in paying, you don't have to pay $6,000 additional to what you're paying in rent alone. So if you're paying $2,000, you know what I'm saying? That's going to take you to what, another year only for your rent to go up even more in the market rate when it's high, right? I just be trying to wrap my mind around it. Why not pay a mortgage versus your rent? And a lot of people, I don't want the responsibility. If you don't want the responsibility to own a house, I would say that I got my opinion, so I'm not going to say that. But let's just say this. Do you understand that your mind is limited? You need to open up your mind. If you decided you want to pick up and move, you have a rental property now. Now you have a rental property and you could still get up and go pay rent wherever you want to go pay rent and have that mortgage paid by your landlord, by your tenants as a landlord. Now, most of you probably don't want to be a landlord. You probably think, okay, but how do investors get money? They have tenants. How do you bring in a source of income? If you want to get up and go to another state and see how it is, and you can also take equity out of your house to go buy another property, depending on how much equity you have in your house. You have to think smart and how you do this thing. So don't feel like a house is going to make you stuck in the state that you live in. You don't have to be stuck in the state that you live in. Okay? So the moral of the story is this. Don't be so concerned about the rates that you're willing to pay in an apartment $3,500 for rent when your mortgage could be $2,000. And then when you have the opportunity later to refinance your loan, because guess what happened? When the bank can't make money on mortgages, right? So they have options, right? They can sell the mortgages they have to lend to the secondary market. And Fannie Mae and Freddie Mac happens to be a secondary market. So or the bank could keep it in a portfolio themselves. They can service the loan or they can sell and package your loan and sell it to a secondary market. That's why many of you who do own homes might say, my mortgage lender changed. My bank sold my loan. But what you will also get is a letter stating in that document, those documents, when you sign to buy your home, it states that they have a right to sell your mortgage to another person. But in order for them to do that, they have to also give you advance notice prior to your payment being due to give you enough time to know who that lender is when they transfer your loan or sell your loan. But regardless of what it is, your mortgage still stays the same, your payment. The only thing that changes your payment, if it goes up, is going to be your insurance. If your insurance went up and they gave a higher rate, or the taxes. So if you have taxes that may have been $1,900 for the year and it went up to $2,200, yes, it's going to change your payment, but your mortgage payment is not going to change. Okay? So you will still have that mortgage payment. So it's not like in an apartment where every year it goes up. Okay? And even if your mortgage stays the same with the insurance and the taxes, that's fine too, because sometimes it goes down. Sometimes in a good market, insurance rates may go down if you have good, history with them and no claims and things like that. And you continue, you never lapse in your in your insurance and things like that. So it can easily also go down. And when that happens at the end of the year, sometime around December, you will get an escrow overpayment due to you because your insurance went down or your taxes went down. And you'll probably get depending on how much your house is and how much you paid in your escrow, you'll get that sent out to you in a check. Okay? I know because it happened to me. So I'm telling you what I know, not what I think I know. I just want to say to you guys, don't get scared because they're out there putting fear in your heart. If you position yourself, I always told y'all, position yourself to the yes position and you will get the loan. If you follow the plan, the strategic plan that we put together based on the goal that you tell me when you come to my credit education class, then you're not going to have a problem. Everyone that I put in the yes position got approved for their loans, whether it was a personal loan, a credit card, or a mortgage. So what I'm trying to say to you is, if you position yourself correct, like you're ready, you're not going to have a problem qualifying for a mortgage. Unless the bank ain't got no money to give you for the mortgage. And understand why the bank has to charge you more money. And why, when the rates go up, so here it is. The feds will raise the rate to 4%. The bank is going to charge 7 to 8% in mortgage, right? Because they got to make their money. Now, if people not getting mortgages and people are pulling out, guess what? Eventually, nobody's buying homes, right? Where the bank, where are they going to make their money? Yeah, they got other avenues to make their money, but don't you think that they're going to probably try to promote refinances for a lower rate? That's an option. So if you get in and you don't like the rate and you're like, okay, this 7%. And then you have a bank that's willing to say, hey, we can offer you, a refinance with a cash out payment or no cash out payment, depending on your equity and things like that and other factors. But you can refinance. Okay. So you may have started out with a 7% rate, but who knows? A refinance may take you down to if it makes sense for you, may take you down to 6% or 5%, depending on what the market is going to look like. I'm just saying that don't give up. At what goes up comes down. What comes down goes up. We all know that makes the world go round. So eventually there was at a point where the interest rate for a home was 19%. And you might be saying, well, Aisha, also the homes were like $7,000, right? But that $7,000 back in that day was just like these $200,000 and $300,000 houses to us. Okay. It was a whole lot that people had to work for to make that money. So times change, but understand that it was hard at one time to get 5 cents to buy a loaf of bread. Okay? Just because, and now today, a loaf of bread is about $4 to $7 to $8 for a loaf of bread. You might be like, where you shopping, Aisha? Yeah, that's where I'm shopping. $6 and $7 for a loaf of bread. And the store brand alone is $3 today. $3 for the bread. So what I'm trying to say is, yes, the rate went up to 19% on mortgages at one time. So you could get in still if you want to, but you got to position yourself. Don't be at your maximum, DTI. And number 2 is I advise you, do not have anything on your credit that you have not discussed with your realtor or your lender, because prior to going for a loan, you really need to know what's on your credit. And y'all people who tell me that y'all don't know and y'all didn't know this was on your credit, that is a lie and the truth ain't in you. Because every transaction that you have to do when it comes to your credit, if you got medical bills you didn't pay, if you have a mortgage you went and foreclosed on, if you had a car payment you didn't pay off, if you had late payments in the last 2 weeks, because let me tell you something, those are events that So stop acting like y'all don't know stuff and and then y'all applying for these loans only to get denied. And then that there's something on there that could prevent you from getting this mortgage. And then you get mad when you are denied. And you wasted your time, everybody else's, and guess what? You have a few hard inquiries on your credit now that took your credit score down. My idea for you is to not let your credit score go down. Okay? Your credit score should be where it is. And understand this. 3 months typically is when you actually you go look for a home, you put it under contract, and you get the loan and close. It is at least 3 months. For me, like I told y'all before, I pre-qualified in February, put my application in when I found the property in March, and closed in April. Okay, typically 3 months. But if I position you and show you everything that you need, once you go ahead, get approved for that loan, and you find that property immediately and still put the contract in underneath at that same time, and you've been looking on my website, the garealestate.llc.com. If you've been looking for your property on that site and you know you want that, and we went and we saw that property, you want it, it's still on the market, and you put your offer in, it got accepted. So let's just say you got your pre-qual in November. You put the contract in just before the end of November. In 30 days or 29 days, you can still close later. So that could be 2 months. Now you might be like, Aisha, that's pushing it. If you get in a position and you listen to me and you do what I told you to do, I'm like boot camp, y'all. I'm not going to sit here and be like, you guys see me in a nice mode and cool and everything. But when it comes to business, it's boot camp with me. Because if you tell me your goal is to do something, I'm working towards your goal. I'm working towards your goal like you working towards your goal. So if you're not working towards your goal, then why am I working hard for you to meet your goal? Because if I'm working harder than you, then you're going to give me opposition in getting to your goal. The strategic plan is laying step 1, 2, 3, 4, 5, 6, 7, based on what you told me, what you have, what we looked at, what we discovered, what we analyzed. This is what you told me. And I'm always going to tell you, you told me, you said, because one thing about effective communication with me is I listen, I observe, number one, I actively listen to what you're saying. I write it down so I can make sure I know what you said. And I summarize to you what you told me. So therefore, when you say you understand, I consider you understand the goals that you put together and the desires that you spoke to me, and we making it happen. I'm your teammate. I'm not some person that come into your life and tell you, come on, we're going to do this. No, you got to want to do this. It's just like the horse. I could take the horse by the water and the horse decides I'm not drinking that water. He gonna be thirsty. She gonna be thirsty. Okay? But no horse that you lead to the water is gonna refuse the water, because by that time the horse knows that they need the water. So therefore, at this time when you come to me, you know what you need. And so we gotta drink the water together. Okay? So we can make each other's lives valuable, add value to each other. I add value to you by helping you accomplish your goal, and you add value to me by helping me be happy about you meeting your goal. Because one thing about me is I don't want to win and you don't win. I don't want to get something out of the deal and I made you lose in the same deal. If I win, you win. If you win, I win. We win together. But for you to lose in a transaction that you're not happy with, I lose too, because I lost on making you happy with what you was doing with me and me coming to be your partner. The idea of getting connected is to each one teach one and to be that one that you walk with. You know what I'm saying? So when you're a little weak, I'm your strength. When you're a little weaker, I'm your strength even more. You know what I'm saying? And when you look like you want to give up, I'm there to tell you, no, don't give up. I got you. Come on, let's do this. I'm going to walk with you. I'm going to carry you if I need to. So I'm with you as your teammate. But if you're not moving, I'm not moving, because I can't move unless you move. When I move, you move, just like that. When I move, you move, just like that. Y'all get it, right? But anyway, listen, as I always say, take life by the throat and make it speak into existence what you desire, okay? Be the I am inside of you, the great I am inside of you, to go after what you want when you want it. Don't matter about the red tape. I don't like red tape. I just go and do what I need to do. You know what I'm saying? So when I want something, I go for it. When I say I'm going to do something, I do it. When I say I want something and get it, people like, yo, you're a go-getter. You say what you want and you get it. You say what you're going to do and you do it. And that's what I want people to know about me. My word is my bond. Okay? So if I gave you my word, you have my word. And you could take it to the bank, and I guarantee you, you're going to get interest on that. You're not going to get a bounce check. Because I'm all about my word. I'm all about your success. Your success is my success. Your failure is my failure. And I don't like failing. And I don't fail. So therefore, let's win together. Let's do this. So the market, don't get stuck on the market.
Get stuck on your vision. Write your vision, make it plain, speak it into existence, and go for it. Say, okay, excuse me, excuse me. Say, okay, guess what? I'm going for it. That rate, I'm not going to let that scare me because guess what's happening? People are falling out of contracts and they can't get the property they wanted. So, what does that mean? It made room for you. Now you can move in and get the property you want because somebody else cannot come in because they wasn't in the yes position. They can't get the property. So now you could come in and you could get the property. You have positioned yourself in the yes position. Even if rates go up, you can still afford it. If rates go down, that's wonderful. That's great. So either way, you're prepared, and that's what I do. Y'all know I come from. I worked in insurance. Okay, I saw how they did the insurance when it came to auto and loan. I worked in, you know what I'm saying, a lot of customer service. I mean, I opened credit cards on the spot. I worked in a bank. I see what denied people, what people got denied. I mean, people with 800 credit scores got denied because of their DTI. So I seen different type of situations from the mortgage and from the banking perspective. And now being your realtor, getting you to that table and closing with you is my dream. It's your dream, but it's my dream as well. So we dream together to win. I'm here to help you guys be winners. So you are a winner. Let's do this together. Y'all know me. Y'all know me. If I lose, man, listen, I'm going to pick my face up and I'm going to keep on going because I may have lost right here to fight, but I'm going to keep on going because I live to fight again. And when I win that fight, look at these heavyweight boxers, right? You think they ain't got no losses? They got losses under that belt that they won. But guess what? They kept on fighting and they never gave up. They never gave up. Lightweights went to heavyweight, okay? So go from your lightweight and be a heavyweight champion in your life, all right? Peace. I know this was long. I be trying, but hey, y'all know how we do it. I'm going to keep on saying what I need to say. I'm sorry it was so long, but hey, if you don't respond, you don't ask questions, it doesn't really motivate me to come on and do this thing. But if you ask questions, make comments, and share the video, then of course I'm gonna keep it coming. But until then, I'm gonna watch your energy. And don't worry, I'm gonna watch your energy and I'm gonna move and flow. Okay? So peace. I hope this video helped you guys. If you can like it, share it, and comment it, comment on it in, down below. It would be really, really nice to let me know what you want to do. I can help you walk through the process. And I got another video out there, is the process before the process. So let me know what you want to know. Ask me questions. I'll answer them for you. All right. So hey, if I can't answer them, I'm gonna get some expert to help you and get it in. So listen, we're gonna get those questions answered. So ask. If you want to know what this market is like, if you want to move forward and buy your house, reach out to me. Speak your desires at AyeishaMcNeil.com. You can always email me and say, hey, or like I said, Ayeisha.GARealestateLLC.com. You can go there, join, and look at some homes in the areas you're interested in. Or you can go to AyeishaMcNeil.com. You can register for the credit class education. You can purchase My Credit Was Effed Up But, or a trip to the bank with daddy. Kids saving for their future. Something else is coming. I told you guys before, but I can't really release it yet. But when it's out there, it's coming. I got you. All right. And in fact, I'm probably going to give some things free away to my subscribers. Not probably, but I will. For anybody who have any questions, and contact me in regards to home, listen, you might end up in the raffle winning to get a free book. My Credit Was Effed Up But. In that book, it tells you how your credit is read. It tells you about my experience in college with credit and what happened to me. It also tells you what documents you need when you're applying for a loan. So if you're interested, you can also find it on Amazon and purchase it, or AyeishaMcNeil.com. All right. Peace.